Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays, which is take a look at the four major market ETFs. We're going to take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we conclude with that, we'll take a look at the U.S. dollar, see how it's affecting gold and silver, and then we'll look at oil as well. Once we finish that, we'll go ahead and move on to chart requests. Anyone that's in here, if you have a chart you want to look at, you want me to look at, if you have a chart that you have a question about, whether it's something you're holding or whether it's something you're looking to get into, maybe it's even just a question on a pattern that you see, feel free to type it into the chat, and when I get a chance during the second half of this stream, we'll go ahead and take a look at it and see what we could figure out with these charts. If you like what you see, you can always follow me on Twitter at StockDarts, where I typically post when I'm going to have these streams, or if I'm going to have some sort of an impromptu stream or video, or when I put stuff up on my my Patreon page. You can also go visit us at YouTube at StockDarts, where you can find the recaps of these Wednesday market reviews, or you can visit me at patreon.com/StockDarts, where I post weekly blog content. I'll typically on Mondays put up an idea of how I'm going to go ahead and trade the week. I usually put a watch list or particular trade ideas that I'm looking at, and I'll often update it during the middle of the week if they're trades that look like they need to be followed up on. And then, of course, we also repost these Wednesday market reviews on there as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. Let's go over here to TradingView. For those of you that were here last week, you'll know that we were looking for a bounce, and we were expecting there to be some trouble around the 20-pair moving average. And so far, that is exactly how it's played out. You can see today we opened up pretty sharply down compared to what we've done the last couple of days. We did have a very positive start to the week. This is the first week since we started breaking down where we had 2 or 3 days, especially 3 days in a row. And as you can look on the S&P 500, we actually strung along a nice little batch of 5 green days, 1, 2, 3, 4, 5, which is something we have not seen in quite a while. As a matter of fact, since before this whole coronavirus thing started shaking the entire markets and basically the world. And I think it was something we needed. For those that have been around these last couple of weeks, you'll know that I don't think that the selling is done. I don't think that we're done dropping. But I was really looking forward to having a bounce like this, because now we could drop a bit and not form new lows and not continue to spiral downwards in the overall markets. This is really the first step towards making a tradable range and starting to figure out exactly where there's a definable bottom in the market, so we can start looking at where the buyers are willing to support, and in the long run start to trade sideways and then eventually try to make our way back upwards. Now the issue that we're having right now is that we are still in a situation where there's a lot of news that could come out during any particular evening or any weekend, and that could make it a lot worse. Bob, I'm not sure if anyone else is getting that, the echo. By the way, guys, Bob and Wes, it's easier if you put it in, if you type it into the Twitch chat than the Discord. I tend to have the Discord in the background here. But let me know. I'm not sure what's up with the audio. If there's something that's up with it, hopefully it cleans up in a little bit. Let me know if it still keeps going on. All right, good. Yeah, I'm not sure. Sometimes I think it's my microphone. Sometimes I keep it kind of far away from myself, and maybe that's what the issue is. What was that? All right. So let me know if it's always going to lag. That's kind of an issue. I'm not sure why, if it's something with Twitch or with my PC or what. But let me know if there's any more audio issues, or if you need to zoom into the chart a little bit more, and we'll go from there. But yeah, so we were talking about the market and the fact that I think that there's potential for basically for downward surprises for quite a while now, right? Until we're completely out of this quarantine, until we're back to work and everyone's traveling, we can expect at any point a surprise in the news, whether it's a famous person that dies, whether it's a big escalation in what's happening in New York, or maybe something like that starts to happen in another major city, or whether a company decides to declare bankruptcy. There's a lot of stuff that could turn around and scare the market and scare people out of stocks again, right? So we always have that issue now, and that's going to be something that we're going to have to face going forward. So with that downward potential, what we want is we want to do stuff like we did this last week, where we start to kind of climb outward a little bit out of this hole that we've dug, so that when we do get those surprises, we come back into levels of support rather than past them and trying to figure out where the new levels are, where buyers are brave enough to step in and support the market. Like I said last week, I expected the 20-pair moving average to be a pretty decent area of resistance, and so far that's played out. You can see on the S&P 500, yesterday we tried to get above it and we failed, and then we opened up pretty significantly down today. We also broke a pretty short-term uptrend, right? So showing that maybe the bounce is done for now, and if that's the case, we're likely to head down into the next couple of days and start to test support. And I think the next level of support is going to be somewhere in this area, around 236, 235, and that is the area that I suspect we will find support now. And this is in an ideal scenario. We don't head back to new lows, right? We start to trade sideways. We start to find buyers stepping up and supporting price, at least at the very least in the previous areas of resistance. Support. And if that's the case, then we should expect buyers to maybe step back up around 236, 235. And so that would be, in my opinion, what we're kind of hoping for. Now, of course, it could be even better. Maybe we bounce at the end of today and tomorrow. We come right back up and start making our way back towards the 20-pair moving average. But I suspect now that we've had that nice 5-day bounce, that there's a little bit of selling that needs to take place, and more likely than not, we're going to head a little bit lower. And the idea is that we don't fall back below 236. We could find support maybe up here 242. We could find it right where we are right now, and then go from there. Now, a lot of times in these scenarios, when you break these short uptrends, you have a drop, and then you come up and retest it, and then that next failure is the one that's more dangerous, right? So whether we find support right at this level at 247, whether we find it in the 243, or whether we come all the way to 237, the idea is we're going to come back up, right? And if we can't clear this area, then that will likely mean that we're going to have to come back down and start testing the lows again, right? So basically we're going to do this, right? We're in the process of dropping. Let's change these lines. We'll do red lines for this, right? All right, so we're in the process of breaking this short-term uptrend and starting to drop, right? Whether we come down to this area, down here, or all the way down to 236, we're going to eventually, of course, turn around and bounce again, right? And assuming that we don't head to new lows, which I think is the more likely scenario, is that we don't head to new lows on this initial drop that we're experiencing today, we're going to make our way back up eventually and test the 20-pair moving average, test this area around 255, and then possibly even 261, but more likely than not the 255 area. If we cannot get back above that and we roll over again, that second drop, I think, is the one that has more potential to lead to new lows. And I think that's the one that we need to be more worried about, not what we're seeing today. Now again, take that with a grain of salt, because like I just said earlier, news can quickly change the entire character of this market, and we could end up heading to new lows if some ugly news comes out and things really escalate. But assuming that we're in the status quo and nothing changes as far as the economic pattern that we're seeing, then I suspect that we'll find a bounce over the next couple of days. I think buyers are starting to filter in and seeing some of the nice price discounts that we're getting across the board, and are starting to step in and be a little bit more bold. And I think that's going to continue as long as we don't see this volatility start to increase again. But what I do think is going to happen is the next time we get a bounce, that might be the more dangerous one, and the one that we really have to be a little bit more cognizant of. So for now, what I'm expecting is that we should drop, at least for today, maybe even the next couple of days. But hopefully we find support around 236, and we start to make our way upwards. And then that second attempt is the one that concerns me a little bit more. Now, keep in mind, if we do lose 236, that's not good, and that likely means that this whole scenario is not going to play out, and we're just going to go ahead and test lows right away. So this is an important level for us to watch, this 236 level, and the 256 or so is another key level to watch to the upside. And I think those are the two critical levels right now to watch in the S&P 500. And then if we can get past that to 20, like I said last week, and I'll just to go over it again this week, these moving averages, they're not just squiggly lines on a chart. They're a good picture of of sentiment in the market and what traders think of the market, right? And so when we start to approach that, when you have a significant shift in character in the market, when you see a huge change in trend, going from a strong uptrend to a very, very strong downtrend, typically you're not going to break that trend. You're not going to basically shift that sentiment on one try. And so that's what often happens when we come up and test the 20-period moving average on that first attempt. And why it typically fails is because you're not going to be able to turn all this sentiment around with just one quick bounce in the market. A lot of times what's going to end up happening is you're going to need multiple rallies before you can shift public sentiment and start to get people more bullish and start to get people at the very least more neutral, thinking that the market is done dropping. And so think of this like momentum. When you pick up this much momentum, you're not going to be able to stop it on just one quick try. You're going to have to take a few tries to eventually slow it down and then stop it. And so that's what we're doing right now, is we're starting to slow down the descent, and hopefully we can get another bounce or two and eventually turn that back sideways and start to trade, and then maybe start to get above the 20 period, showing that traders are starting to shift their sentiment back towards the upside. And so that's really where we're working with right now, is trying to slow down this downward bias. I don't think at this point we're really looking to reclaim this entire drop and to bounce back to highs. I think that's a little optimistic, to say the least. I think that really what we want to do right now is just stop the bleeding and start to find support, start to find a little base of operations where we know that buyers are going to step in and with confidence support the stock market. And again, we're not really there yet. We're getting some, obviously the stimulus is going to come in, and that's what this recent bounce was on. But in the end, we're still facing a lot of issues. If we stay shut down, if everyone stays kind of quarantined and cities continue to keep everyone home for 2 or 3 more months, then the impact that's going to have on our overall economy is not going to be canceled out by the stimulus package, and we're going to continue seeing more downside in the stock market. So at this point, what we want to see is things start to improve. You see the growth curve of the virus start to taper down a little bit, and maybe we finally get that turn sideways, and then from there people can start thinking about going back to work. But for now, with the way things are going, I suspect that we're still going to see more downside. So you don't want to get too over optimistic about buying, but you also don't want to get too aggressive with the short side, because a lot of times rallies in these bear markets, they can be pretty swift and they can be pretty strong. And if that's the case, you could be caught on the wrong side. So like always, you want to be disciplined about trading. Those of you that follow me on Patreon and watched my video this week, we discussed shorting. Despite the fact that we opened up the week strong, we were looking at potential short candidates as we bounce, because again, we're in a very volatile market, and I don't think that even if we've bottomed out, I don't think we're ready to climb higher. I think that we're still going to see a lot of periods of selling, and so the last couple of weeks we focused on a lot of good long-term long names that we wanted to buy at discount, and that I think are going to weather this storm of self-isolation and being quarantined and working from home. And then so this week what we focused on were names that I think are going to get hit hard, and we'll discuss that in a little bit more detail when we cover all the markets and we go into the chart requests. Some of those names that I decided to focus on, most of them are pretty obvious, but my idea was that even though we were bouncing, it was time to start looking at shorts. And I think that's what you want to start doing in this market, is when we have rallies and we finally get some green candles, you want to start looking at which names you want to start looking at shorting on bounces. And when we start dropping and heading towards support, you want to look at which names you want to focus on as far as buying at support, and taking advantage of the discounts that we're getting with these swift drops in the market. And I think that's really how you want to go ahead and trade right now. Rather than try to chase the longs or try to chase the shorts, you want to be doing the opposite, or thinking of the opposite, and waiting for these inflection points where the market turns around and starts going in other directions. So that's the S&P 500. I don't think we have to look at price action above 263 right now. I think if we get above that, then we're likely going to make our way up into the low 270s, but more likely than not, we're going to be caught up in a range right now between 263 and 222, and hopefully really 237 and maybe 260. And if we stay within that range, then again, I think it's a positive. I think it's a good sign that the markets have started to stabilize and are starting to look at trading sideways and building out a range that we can maybe trade on. Now, if we look at in the long term and see what we've done, you can see again this area, this 255 area is pretty critical, right? Because that was basically the bottom of a range that we spent a good portion of 2018, 2019, and even part of 2020 in. We had that one dip in 2018, which is kind of where we came up to as we dropped below there. But you can see what we're doing right now is we're holding below that range. So the real critical thing for the bulls right now would be to get above that range. But I don't think we're there yet. I think at this point what we're doing is basically trading, and you can see it pretty clearly if you look at the long term. Right, we're trading in this range that we spent the very end of 2018, which is below the base and right at the lows that we formed. Now, go ahead and we go back to the daily chart, and you can see that's really what we're doing right now. We're basically trying to break past that point, that 255, and get back above it, which is where we broke the downtrend or the uptrend today. And then that level of support is right around that area, right around 236 to 235. So, it's interesting. A lot of times price has memory, and people do remember those prior price points, and that's kind of the range that we're struggling with right now. And depending on what side we break out of, it'll give us a good clue as to how we're going to go ahead and maybe trade as we start to head further into April. All right. Let's take a look at the NASDAQ. And you'll see it's an interesting thing. The NASDAQ actually was able to break above the 20 period, showing some relative strength as it has been recently and will probably continue to do so. In my mind, some of the best names to trade right now, if you're trading to the long side, if you're looking for trades to play to the long side or to weather the storm a little bit better, most of them I think are tech names. There's a lot of tech names that actually benefit from people working at home. And those stocks have been doing pretty well. And again, those of you that have been in here and have watched us over the last few weeks, you'll know which ones they are. I've gone over them several times. I've put them up on my Patreon page for 2 weeks now. Your usual suspects, stuff like Amazon, people are going to still shop online. You have stuff like Zoom and Citrix, which people are using their software to meet online, and they're doing very well when you compare them to the overall markets. And so these stocks are all doing very well, and they continue to perform and outperform the market, and most of them are tech names, and there's a lot more. Again, like I said, I encourage you to visit patreon.com/stockdarts. At this point, those posts are free, and you can go ahead and take a look at some of the names that I put on there. There's a lot of names that are set up to kind of withstand some of the economic pressures that are happening now a little bit better than others, and so a lot of those have done well, and a lot of them are tech names. Because of that, the Qs in particular have outperformed the Dow and IWM in particular, but even the S&P 500, because a lot of the stronger names are tech names right now. Another one, Netflix, of course. And so as long as they continue to outperform, you're going to see the Qs kind of buffered a little bit by that. Now, that being said, we're still obviously pretty weak overall as a sector, and we're doing a lot of the same things the S&P 500 is doing. We're trying to get back above, and here we'll do the same thing here. We'll do the short-term trend line that we just broke. And now at this point, the idea is to not make new lows. Now you'll notice if we go to the long-term chart, again, showing relative strength, right? We're not actually down here, right? So the S&P 500 was trading in this area, relatively speaking, right? They're below everything that we traded in most of 2018 and 2019, except for that dip at the end of 2018. The NASDAQ is still in the middle of that range, right? So it's pretty positive. What we're doing in this case is we're basically struggling with the top of the range and the middle of the range, right? So you can see the middle of the range around 170 or so is where we're trying to find support. And the area that we're struggling to get above, and which we just failed, is this area around 187, which is the top of that range. So the NASDAQ was trying to be bold and trying to say, no, you know what? We're still in a bull market. We're still trying to get above or hold above this previous base that we were trading in, and it failed. And so that's what it was trying to do here. It was trying to get back above 187. We couldn't do it. And that's the level that we rolled over on, right? And so you can see again, 187. We tried to get above it. We actually tried to make our way up to 192 and then came down, and that's what we're struggling with right now. Again, we lost the 20-period moving average. I didn't expect this break to hold. And at this point, like the S&P 500, what we want is we want to find this next drop. We want to find support earlier than the lows, right? So we don't want to find support down at 169. We want to find support somewhere in this 177, 175 area. And then from there, that second attempt is the really critical one. The one where we need to be able to keep the positive momentum going forward and continue trying to make our way back and try to get above some of these resistance areas that are holding us back. So what we want is to at least get back into that range that we spent 2018 through 2019, and if we could do that, then at least we can say that we're back to a neutral phase. We're in the same range that we've spent the last 2 or 3 years in, and maybe it becomes a 4 or 5 year base with an attempt above and an attempt below it, but basically just trading sideways. And that would, in the end, that would be a win for the bulls. And so that's kind of what we're looking for here as far as the Qs are concerned. Now, like I said before, if you're still looking for value trade, if you're still looking for long, stuff to hold long, I think the tech area is still your best bet. I think that's what you want to look for. And I think you want to screen through more tech names than other stuff. Eventually, we'll see maybe some small caps make a rebound. But right now, with traders still having one foot out the door, and with a lot of the Dow components struggling, you're going to see the Qs do the best. And I expect them to outperform the other 3 indices for probably the rest of the year. I just don't see, if the others start to outperform, it's going to be these short-term bounces where they're names that are so depressed that they have to bounce, which is a little bit of what happened this week, where a lot of these really depressed names finally got a little bit of relief because of a potential bailout, and they started to bounce, and then of course that bounce was pretty short-lived, as we'll get to in a minute. So those are the key levels as far as the Qs are concerned. I think the middle of that previous range around 177 to 175 is hopefully the support level we get. This area around 189, 190 is going to be critical resistance that we need to get back above. And as long as we hold above 169, I think we're okay. If we lose that, then I think that we're probably heading toward the bottom of that previous range, which could be some trouble. All right, next up, let's take a look at the Dow Jones. Alright, so again, you can see all the indices are doing very similar things, just to different degrees, right? So here was the uptrend, this very short-term uptrend as we started to bounce. We lost that. We did not get above the 20, so very similar to the S&P 500 in that we made it up to the 20, but we ultimately failed, and we've lost some ground, and we're starting to make our way back down now. Again, if you look at the weekly chart, the longer-term picture, you can see that we're way below the weekly chart. So Wes, you're saying your chart was stuck on spot. You know what? I don't know. Maybe this has to do with, again, a lot of the internet companies are throttling their bandwidth because of so many people working from home, and so it might be something with Comcast where I'm kind of lagging behind. If you want me to, if you have questions, I can go back to charts depending on what it looks like. Let me know. On my stream, when I'm looking at the stream manager, and it shows it's not lagging on my end, but again, it could be my internet, it could be yours. I mean, I don't really know. So I'm hoping we can forge through with this. And worst case scenario, you can always go back and take a look at the recording, and hopefully that's fine. But if for whatever reason I'm talking about a chart and you can't see it, just ask me to go back to it and zoom in, and I will when I see your responses. Okay. Now, looking at the weekly chart of the Dow Jones, you can see again we're way below the range that we spent 2018, 2019, and parts of 2020 in, right? You can see again, relatively speaking, the lagging, right? So here's a look at where the S&P 500 was trading, relatively speaking. This white box, and you can see that the Dow Jones is well below that, right? And here's where the NASDAQ is trading, which of course we're trading well below that, relatively speaking, right? So it shows, again, just how weak the Dow Jones has been compared to the others. And so that's kind of the issue that we're having right now, is that we have relative weakness, and again, a lot of this is due to some of the components of the Dow are doing very, very poor. A couple of them are going to, or one of them in particular is going to be one of my short ideas later on. And as you can see, it's bringing down the entire Dow Jones. Now, the problem with this, in my mind, the Dow to me is a little antiquated to begin with, and I follow it just because the news follows it. But generally speaking, I consider the S&P 500 and the NASDAQ composite to be more accurate gauges of the overall market, but I still follow the Dow because it gives me a little bit of extra kind of eyes on what the market is doing. But overall, I'm not that concerned that the Dow is weaker. Like I said, some of its components are definitely starting to lag behind and getting hit harder than maybe some of the tech names. So the fact that they're weaker is not really a concern. It's just something to watch. And as you can see, what we want to do is the same thing, just at relatively speaking lower prices, right? We want to bounce before we get to our previous lows. We want to find some support here, possibly around 200, and then try to make our way back above it, right? So if we struggle around 213 to 220, it's no big deal. Once we get back above that, I think we're okay. But what we're really trying to do right now is the same thing as the S&P 500 and the NASDAQ, just at a lower relative level compared to where we've been in the past. And other than that, the analysis is pretty much the same. Like I said, the key levels are basically this 220 is the area we want to break past, which is the break point. And then we want to hold somewhere around 195, hopefully 200, but more likely than not around 195 to 193, and not make it back into the 180s. If we make it into the 180s, we got a little bit of trouble. And then finally, we have the small caps. Now, the small caps are not in a good place. Now, if you want to look at it, sure, we're doing something very similar, right? We've got a little uptrend, and we failed at the 20-period moving average, and we're right back into our previous area, right? Unfortunately, if you look at the weekly chart, you can see where we stand on the small caps compared to where we stand on the rest of the market, right? So you take a look at where we spent most of 2018 in, and you can see we traded basically in a range between about 160 and about 130, and more than that really around 145, and we're way below all of that, all the way down to the 190s. We actually made it all the way back to the range that we spent 2015 to 2017 in. So overall, IWM has been, relatively speaking, the weakest of the four major indices, and no surprise there, especially in a bear market. Whenever you have people getting ready to abandon holdings, they're going to get rid of the riskier holdings first, right? And obviously, what's riskier than small caps when you're looking at the four major indices, right? They're the ones that introduce the most volatility and the most risk to your portfolio, so they're going to be the first names that people abandon when they are really worried about the market. So that's kind of where we stand right now. As you can see, we are really struggling to find a foothold and to regain some of that upward momentum. And at the moment, really just hoping to just start trading sideways. Now, you can see we're already kind of towards the middle of this little range between 112 and 99 or 98. Unlike the other indices, I think there's a good chance IWM does come back and retest its lows. And ideally, we just want it to hold its lows. You can see it's hard to tell with all these volume bars, but there's three nice wicks of buying over here. And there's some nice support here right around $100. And if we can find support at that level again and try to make our way back up, then I consider that a win for IWM and for the small caps. And that would be basically probably the best case scenario for the small caps. Of the four indices, if you're looking for downward bias, the small caps are the easiest place to look. And they're going to be the place that gets hit the hardest again every time that we drop in the markets. Of the four major ETFs, this is going to be the one that goes down the most. So if you're worried about holding individual names and you just want to play this with ETFs, then you're probably better off whenever you think we're going to bounce, just go long the Qs. And if you think we're going to drop, then you probably want to go short the IWM, whether it's through puts or however you want to do that. And that would probably be an easy way of navigating these waters if you don't want to get too involved in individual names, if you don't want to trust your money to say just one company or a few companies, and you just want to say, I want to just kind of navigate this little by little, then just long the Qs, short IWM, and you should be fine as far as that's concerned. That's a pretty simple way of taking advantage of the market dynamic that we have right now. And that basically covers the four major markets. Like I said, I think we start off the week very nicely. We had a nice bounce, and maybe we bounced to close out the week, but I think at this point we need at least a couple of days down. Today and maybe one more, and then from there we'll see if maybe we could try to close out the week with a bounce. But like I said, it's once we bounce, it's the next drop that worries me a little bit more than this one. Unless ugly news comes out and we start to see things really fall apart again, I suspect that we'll find a bounce below our previous lows, at least on the S&P 500 and the NASDAQ, and we could hopefully start making a range here that we could start maybe putting a little bit more faith in our support levels than we have right now. Because clearly right now we don't really have a lot of established support that we could count on. And we're only now even beginning to build some shorter term levels of resistance. And when you have a market like this where you're only beginning to develop a range, the edges can be tested quite a bit, right? So we want to see and we want to hope that these eventually become edges of a range, and if that becomes the case, we could gain more confidence in trading them. But for now, you still want to be cautious. If you don't have to trade, you're probably better off not. If you're someone that needs to trade actively, whether it's because of income or because you have nothing better to do at home, then try to be cautious and disciplined about it, and make sure that you're doing it in a way that makes sense and not just gambling, looking for some fun. Okay. Let's take a quick look at the U.S. dollar. Then we'll look at oil, gold, and silver, and then we'll get on to the chart requests. Those of you that are in here, type out any charts you want me to look at, and I'll take a look at them as soon as we cover this. We're not going to spend a lot of time right now with currencies, because I think currencies are in a very weird place, and they're just fluctuating pretty wildly. You can see UUP. You can see how the chart, and I'll do this first. So this is what the chart has looked like for the last 6 months as we discuss the U.S. dollar index, right? And you can see the massive volatility that's come in, and how all of a sudden the chart got all smushed up because of just how crazy the moves have been recently on the U.S. dollar. There's been a lot of fluctuation. Of course, there's been a panic worldwide. There's been a flee to the U.S. dollar to a certain extent, but then the U.S. dollar continues to, we continue to print extra money and lower interest rates in order to try to save our own stock market, and that's causing these big fluctuations back and forth in the U.S. dollar, and that's causing a lot of these forex crosses to kind of go crazy also. I think at the moment, if you're looking to trade them, here's a look at the euro US dollar. You have to understand that there's going to be a lot of reversion back and forth as these things chop around until we can narrow down the range a bit. You can see these have been very massive moves up and down across the board, and I think at this point you can see the US dollar is starting to gain ground. Remember, this one, euros, in this case, this chart is based in euros, so up is good for the euro and down is good for the US dollar. And in this case, you can see the US dollar is gaining some strength again versus the euro after the euro had a big explosion. And then it fell apart. And so we're going back and forth. And I think at this point, what you want to do is try to figure out these points to go back and forth. But I think at the moment, in my mind, the forex currencies are pretty wild. And you have to be pretty careful about how you trade them, because there's been a lot of back and forth. I think the US yen gives us a decent area here of potential support as this volatility hopefully starts to contract. You can see it's been expanding for a while, and hopefully at this point we've seen the explosion that was needed, and volatility will start to contract. And if that's the case, then we could see maybe a bounce in this area, and it could start to make its way upwards from 107 back to 110 or so. And then finally we have the US Canadian dollar. And again, you'll see a wild fluctuation. Now this one, because of oil, the US dollar has gained a lot of ground versus the Canadian. And despite the recent drop, it's starting to bounce again because oil continues to really struggle. If you take a look at crude oil, you can see we actually dropped below $20 yesterday, and we're right back above 20, but we're really struggling here. And with the slowdown in the economy, obviously there's going to be a lot less energy consumption, and there's going to be a lot less demand for oil. People are staying home; they're not driving. Companies or factories are being shut down. Just energy, we don't need energy as much right now as we did just 6 months ago. And of course that's going to be reflected in the price of crude, and it's just really being hammered. And really you might get a relief bounce here, but I don't see a change until we start to get out and start working again, and the economy starts to pick up again. So I know there's a few people in our Discord chat. I know, Sam, I think you're in here, that you've been trying to catch oil long for a bounce. And you're doing it in an interesting way with options, which makes sense. But I think long term, you look at the depressed oil and you say, the depressed price of oil, and you say, well, it's going to bounce, and yeah, it will bounce. A year from now, 2 years from now, oil's not going to be at 20 again. It's going to be higher. But I think in the short term, 2, 3, 4, 5 months, there's not a lot of potential for it to really get above, say, the mid 20s and back into the 30s, because I don't think the demand is really there yet, and it's not going to be there for a while. Now that being said, that doesn't mean traders can't structure their trades in a way where they could benefit from relief bounces. No matter how depressed an equity becomes, it will have bounces of relief because, of course, price is going to fluctuate back and forth as buyers and sellers step in. And there is the possibility that this is a little too far gone and that 20 is too cheap and that it needs to come back up into the mid-20s or 30s. So I'm not saying it can't bounce, but what I'm saying is oil is not going to really have a strong turnaround until we start to see the economy pick up a little bit and we start to see more energy consumption. And then finally we have gold and silver, and they are fluctuating pretty wildly as well. Gold not really having the move you would expect, the fleet of safety move that typically comes with a market starting to struggle. Typically, if a market crashes, you see money go into gold, and you see money flow into it because it's a safe haven, right? And we're not really seeing that. In the beginning, you can expect it to drop maybe because of forced liquidation of holdings, but at this point, you would expect money to kind of be moving into gold, but that's really not the case, and it really hasn't been the case for a while now, where gold has really been that big of a safe haven. But we'll see whether that continues or not as we start to, as more economies have to lower rates or print more money to kind of bail out each other's industries, whether people start to put money back into gold. But for now, it's just fluctuating pretty wildly. I think it's due for a bounce in the short term. I think that it's not going to come all the way back down to the 130s on this initial drop here. I think that we will find some support. So in the short term, it might be due for a bounce. You can see a little bit more clearly on silver, where we have this attempt. We had a bounce and then we came back and retested, but there's a gap here that I think should act as support and should try to lead a little bit higher. Now again, I wouldn't recommend trading silver. I don't think that it's worth the potential move that you can get on silver is not really worth the risk that you're taking on it. Gold maybe a little bit more, but overall, I'm not that enthused about gold or silver or oil right now. I think, like I said before, to the long side, I'm more concerned with tech names, and to the short side, I'm more concerned with names that are really struggling with the economy being shut down, which we'll get into in a minute. So that covers it for oil, gold, silver, and any commodities. Like I said, we have 8 people in here. If you guys, anyone that's in here, if you have a chart you want me to look at, you have any ideas that you think work in these kinds of market, feel free to add. I'll start by saying this week on Monday, like I said, I started looking at potential short names, what I consider to be kind of the cream of the crop as far as names you want to short when we get a bounce. Now, a few of them, unfortunately, had already turned down as the week started, which is, of course, the cruise lines. Anytime they bounce, you should probably look at shorting them. They didn't get bailed out. At this point, they're just basically stuck on their own. And obviously, they're not operating right now, and they're going to be struggling for a while. Even once we start getting back to work, people are still going to be scared to go on cruises until we're 100% clear of the coronavirus or any other effects of any more flus that are lingering around that might remind us of the coronavirus. So generally speaking, these cruise lines are going to struggle. And as you can see, they came up. They were ahead of the markets in that they already started to roll right back over before they hit the 20 period. You can see again, if we want to go ahead and do the same, they had that upwards trend, and they're losing ground ahead of the market. So they're actually, it's the same pattern, but they're like 2 days ahead, right? So the market right now is right around here, and they've already dropped for 3 more days. They had them bounce yesterday, but as you can see, the cruise lines are, and the 3 of them that we're looking at are Carnival, Royal Caribbean, and Norwegian. And you can see all 3 are really struggling. And any of these 3 really become good shorts anytime they bounce up into some resistance levels. Now, unfortunately for now, it's too late to go ahead and do them. But go ahead and add them to your watch list. These are the kind of names that if you were paying attention on Monday, maybe, or Tuesday, you would have gotten a little bit better of a shot. But really, it was last week when they started to roll over, like on Friday and Thursday. And next time they bounce up again, I think it's going to be more of the same. So as they start to develop a range, you can go ahead and play the top of that range and short them, and I think that they're going to be pretty safe to play. we'll get to Apple in a second, Butterface. Thank you for the request. Another name, a Dow component I was alluding to a little bit earlier, is Boeing. Boeing was struggling even before we had this, before we had the coronavirus pandemic start to really take a hold. They were struggling with, of course, the 737 MAX being grounded, and generally speaking, the entire airline industry has been hammered. And I think of between Boeing and the major airlines, I prefer shorting Boeing, although I think both are good, and the next chart is actually going to be an airline that I think is worth shorting as well. But as you can see, it's the same sort of thing. They already made a bounce, and they started to roll over ahead of the markets, and are struggling. They did get a nice little recovery on the potential bailout, and they will be bailed out. But I think overall, in the long run, they're still going to struggle. It's going to be a while before airlines are going to be spending money to buy new airplanes. And I think just generally speaking, there's some clear levels of resistance here. And if Boeing never makes it back to them, I think it becomes a pretty clear-cut short until we see a pretty significant change in the overall markets, or in our overall economy, and how we're going to go ahead and behave in the near future. Another one, of course, is American Airlines. Any of the airlines I think really work well. You can see it's already back to lows. It's going to be difficult for traders, difficult for consumers to even want to go ahead and fly until, again, there is absolutely no chance whatsoever of them being infected and becoming sick. So even once we start going back to work, people are still going to be a little bit more worried about flying, and there's going to be a slowdown for a while on travel. And these, regardless of being bailed out or not, the bailout's only going to be able to keep them operational for a certain amount of time. They're still going to lose money, and they're still going to struggle to kind of make their way back. And so, again, these are kind of obvious names, but I think sometimes people get a little too cute with their trade ideas, and they try to get a little, they try to be original with what they're doing. And I think right now the easiest thing to do is just take the obvious trades, right? Airlines, no one's going to fly, no one's going to take a cruise, and on the opposite end, people have to work from home, so they're going to use stuff like Zoom or Citrix. They're going to, stuff like TDoc, which is an app that lets you, it's basically a company that lets you access your doctor through your mobile phones. Stuff like that works when you're home. Stuff like NFLX, right? This is the kind of stuff that, if you want to go long, it's obvious, but it's working, right? And on the opposite end of this, of course, is stuff that it's obvious that it's not working, but it's, it's the trade that makes sense, and it's going to keep working because there's real reasons for this. So those are some of the names that I was focused on this week as shorts, and anyone that followed me on Patreon would have had a quick, they would have had a head start on maybe trying to short some of these names as we bounced these last couple of days. So Butterface, you want to look at Apple. Apple's an interesting name. Last week we were looking at some potential names you want to buy at a discount. Now the thing with Apple, I like Apple as a long-term company. I think in the short term, this is a name that actually is exposed to the potential economic slowdown that we're starting to see. There's going to be, with less people working, or a little bit more strapped for cash because they're working less. For the most part, Apple, even though phones at this point are necessities, you can still consider Apple as a company that specializes in discretionary income, right? People are typically going to spend on Apple products when they have extra money. So I think Apple is going to continue to struggle a bit. Now, it will hold up better than most because it's still a well-run company, and it's still a company that's profitable. However, I think if someone's looking to swing trade and to try to play bounces in the market, Apple's not the case. It's not one of the names I'd focus on. As far as the FANG stocks are concerned, like I said, I think you're better off with Netflix or Amazon. However, if you're looking, the other side of this coin, of course, is if you're looking to take advantage of the quote-unquote blood on the streets, and you're looking for long-term names and discounts to buy them, then in that case, Apple makes a lot of sense, because this is the kind of name that everyone should have in their long-term portfolios, whether it's their retirement account or just a stock account that has longer positions. Apple, Amazon, the FANG stocks, you kind of want to have some of them in there, even if it's a little bit. So you want to be able to add Apple whenever it has a drop, right? There's a lot of people that really doubted this company in 2008, 2009, because they were scared of the overall market, and they lost an incredible opportunity to buy Apple at a severe discount. Now, of course, this is split, so it wasn't trading at 13, but it was trading pretty low. And then when it split, of course, it adjusted to the 12, 13 range, but it wasn't really ever trading at that. But you can see the long uptrend it's had over the course of the last decade, right? And when you have a name like this, you know it's more likely than not it's going to continue trading like this until we see a fundamental change in its business model. And I don't think we've seen that yet. Now, that being said, we do have a break in a pretty significant uptrend that's been in place for 2 years now. Again, we're back to the weekly chart. So at this point, typically what happens in these is you break down, you come up, you try to retest to get above that, and then you ultimately fail, and then you either start trading sideways or you head lower. I think in Apple's case, it's probably going to keep trading sideways. It just had a nice support level around 230. So long term, 230 is a pretty good level to scale in. Ideally, in these scenarios, we discussed this a couple of weeks ago when we were first talking about scaling into overall positions in the market. If you want to say buy $1,000 worth of Apple, right? Let's say it's you're not someone that could just buy 10 grand. Let's say 1,000, right? You just want to have a small position in Apple. What you want to do right now is maybe you want to put a portion of that, right? So if it's trading at 250 to 240, maybe you want to buy one share, maybe 2 shares, right? Get half of that in. And then if it drops further, then you could add another share at 200. And if it drops even further, you can add another share in the 190, 180 area, right? And then if it continues to trade sideways, and you feel like it's not going to drop below 230, then you can keep adding as it gets there until you get to your full $1,000 position. You don't want to just buy 4 shares of Apple right now and say, all right, I bought my $1,000 of Apple, I'm good. You want to make sure that you scale in, because it's very difficult to time a bottom in a market and in an individual equity. So what you want to do in these scenarios is you want to scale in little by little. Now, that being said, would I buy today? No. I would definitely wait for it to drop a bit further back into the 230 area. And just like the markets, right, we've got this uptrend that we just broke. We're likely to head lower. Hopefully we don't head all the way back to the previous lows. We head down to this area here, at which point it becomes a decent place to scale in. But remember, just like the overall markets, what I'm anticipating right now is we find a bounce here, we come up, and then what happens in the next attempt to get above this critical area? Do we roll all the way down, or do we just keep trading sideways? So what you want to do here is maybe add a small amount, maybe 1 share, right, or 1/4 of a position, and then as it comes up, if it fails again and it comes down, you wait to see whether you want to add another share at that area or whether you're going to need to add another share a little bit lower. And if it goes above it, it's no big deal. Eventually it'll come back and retest. So let's say it does break 258 and comes and starts trading the 270s. It more likely than not will come back and test the 258 range, at which point you can say, well, all right, this is the new support level, and you can add a share there or another quarter position, and then wait to see what happens as it slowly starts to make its way back up. I think long term, this is a name you want to hold. However, I don't think it's a name that's insulated that well from what our economic situation is right now. I think it's a name that still relies on a lot of on people to have discretionary income. It's also a name that, for the most part, requires people leaving their house. I mean, I know you can order this online, but more often than not, people go to the Apple Store, or they'll just, it's not the kind of thing that you need to work from home right now. So more likely than not, it's going to struggle. Maybe not as poorly as something like the airlines or maybe like restaurants are doing. But I don't think it's going to do as well as like maybe Amazon or Netflix that really are not impacted at all from people staying at home. So I like it long term. I think in the short term it's still going to have a little bit more trouble. All right. Anyone else have a chart they want me to look at? I mean, even if it's not a chart, even if you just want me to expand on some of the ideas that I mentioned earlier, just feel free to add what you want me to look at, and we could take a look at that. Now we can call it right now. We only got another 7 or 8 minutes to go for the hour, but I'm probably going to expand. I think. Oh, so another name that I had, I think, on my Monday post was AMC. As you can see, movie theaters are going to struggle as well, and so looking at stuff like AMC and IMAX, They're they're just it's basically more the same. You can go ahead and short these as they bounce into support. I think it's going to be. They were already struggling as they fought the streaming services like Netflix and Amazon Prime and Disney Plus. So they were already struggling for customers, and now with customers staying away for an extended amount of time, the movie theaters and stuff like IMAX is going to struggle even more. Um, Actor 9, you have an interesting question. What about cryptocurrencies? Long term, I'm still bullish Bitcoin and some of the more useful cryptocurrencies. Short term, they're really struggling, and it's weird. I'm not sure if this has to do with people needing more discretionary income, or just kind of raising funds, or what. But I think generally speaking, in the long run, I still think Bitcoin is going to go higher. I still think Bitcoin is going to hit 20,000 at some point. Whether it's in the next 2 years or 3 years or whatever. I still think that in the long term, I do like cryptocurrencies. I still think that to a certain extent they are still a game changer. And as we continue to debase our currencies, it only strengthens the argument for, at the very least, holding Bitcoin. But in the short term, they're struggling. I don't understand the fundamentals for why they would be struggling right now. You'd think that they, like gold, you think that they'd be holding up better as people tried to stay away from what's happening in the stock market. But that's not the case at all. As you can see, we could look at a long-term chart here, right? And you can see, so this is a pretty critical level here, right around 6,000, right? You can see two pretty decent triangles that have been formed over the last few years, right? So you can see Bitcoin, when it had that massive run to 20,000, then it failed. Ultimately, 6 was a pretty good level of support, and then we had that big dip below it, right? Nice cup and handle, eventually made our way back above it, and for the most part have kind of bounced back and forth between about 10 and 6,000. We are at the moment dropping below it, and you can see this is not a good thing, right? When you have a drop and then you try to bounce and you see these wicks. I'm going to zoom in. Right? You had to drop, and then you tried to get back above 6, and we're failing right now. Until Bitcoin gets back above the 6,000 range, 6,200, 6,300, it's in trouble, right? Because the more often you are below these support levels, the more chances of a significant drop and for us to head right back down. So we want to get back above that, and if we get back above it, then there's upside. But again, you can see it's still in the process of kind of consolidating a range here, and it's basically been sort of trading down from 14, and still sort of struggling. I still do like it long term. As far as the altcoins, I think that they are something you probably want to not get too aggressive with. You can see, by the way, if you look at my watch list, I do follow a lot of cryptocurrencies, right? We've got Bitcoin, we've got Ethereum, we've got Litecoin, and then I've got a ton of these smaller ones that I follow, and there's a lot of them, right? You probably want to stay away from almost all of those, and you want to stick to the main ones like Bitcoin, Litecoin, and Ethereum, and wait for Bitcoin to do its thing. And once Bitcoin can establish that it has a bottom and can start making, holding above 62, 6,300 and making its way back up into the 7, 8,000 range, and more importantly, once it could break that downtrend, I don't know what happened to that trend line. Once it could break that and start trading above it, then I think at that point the altcoins might have a little bit more room to run and make their way up. Now that being said, I think Litecoin is another one. If Bitcoin's a little expensive for you, I think Litecoin's is probably a good deal at this range, in the $20 to $30 range. Because when Bitcoin moves up, this thing will follow suit. But just like Bitcoin, you can see we have a downtrend in place here, and we're really struggling to hold. And until that changes, you can expect it to continue trying to make its way down. So I think in the long term, there's still good purchases. Litecoin actually is, this is pretty cheap, I think. And you can see there's a pretty established bottom here, right around $30. It's only $7 above that. However, just like Bitcoin, it is struggling. You had this area that was trying to support itself, and it's kind of failing right now. But if it could hold here and start to make its way back up, I think this one, there's a good amount of potential here. Again, a lot of people don't like cryptocurrencies, and they think that it's a scam. But the truth is, any instrument that you could trade, if you buy Litecoin here at 35, and it just trades in this channel, it's still a double, getting up to 70. So you can still double your money on this in just a regular move up into the channel that it's trading. As it makes its way back up, hopefully later this year. And it's still worth it. It's money. The money you make in any of the instruments is real money. So as long as you are capable of buying cryptocurrencies, it might be worth taking a shot. Again, you want to be a little bit more cautious with this because they're not quite as liquid as stocks, because it takes a little bit longer to get in and out of them. Just the whole process of opening up an account and getting it verified and all that. But I think generally speaking, I consider them, to me, they're trading instruments just like stocks. And if I see a good trading pattern on them, I find that they're worth trading. And like I said, I think in the long run, I still think that they're viable and could be good ones. I haven't paid that much attention to the Facebook one. What do you know that the name of it? I could pull it up right now if you give me the name. Or let's. I don't know. Just tell me whatever the Facebook is. I don't remember the name off the top of my head. I don't see any reason why it's any more viable than Bitcoin or Litecoin. But if you have the ticker for it, I'll pull up the chart. But I don't remember the ticker off the top of my head. By the way, if anyone else in here, does anyone else in here care about cryptocurrencies? Are any of you interested in, or I'm assuming most people in here just trade stocks. But let me know, for those of you that are in here, does anyone else trade Libra? That's right. All right, sorry. Libra. Libra Bitcoin. Actually, wait, how was it, Libra? So this is, do we have Libra US dollar? So this is the Facebook coin versus the US dollar. Now again, I don't really know the fundamentals of it, like why it's better or what the reason they made the coin. I honestly haven't paid attention to it. You can see, right now I would trade it or treat it just like another altcoin. And to me, like I said, to me all the altcoins right now I'm hands off. I'm not interested in trading any of these alternate coins right now. I think that Bitcoin will bounce before these others do. And I think if there's any smaller coin that's going to bounce with Bitcoin, it'll be Litecoin. And then once it does establish that it's in an uptrend, then these will follow suit. And then I would maybe be more aggressive about following these. But right now, this is not a good chart. Again, this is versus the US dollar. You can see it lost this its starting range, its ICO, and it's going down right now. It's not really looking good. And like we said, versus Bitcoin, it's doing just as poorly. I'm not that excited about it right now. You know what? Yes, the Facebook background is okay. So it's good and bad. It's good in that because it's a big company that backs it, it's gonna have it's gonna be more recognizable, and you're gonna have Facebook users that are gonna be more inclined to trust it because they already use Facebook, and people always look for familiarity, right? And they always look for a name that they trust. And so, from that extent, yes, it's better. But at the same time, there's going to be a lot of people that don't trust it because it's Facebook, and they're going to try to. They're for all you know, it's another way for them to try to take our information and use it in a different way, and it's them trying to get a foothold in an area that's basically supposed to be about freedom, and it's supposed to be about not having corporations or governments influence your currency, you have this big corporation that's trying to monetize it and do it in their own way. So it's a back and forth. I think the people that are really into crypto and the real believers of it are not going to trust it, but the average Joe is going to trust the familiarity with a company that they know, right? So there's that. Now again, I haven't really looked into why they made the coin and what it's about, so I can't give you that much about the fundamentals. But the technicals, it doesn't look that great right now. And like I said, a lot of these cryptos, a lot of these alternate coins, no matter how good their story is or their product is, they tend to really get influenced by the overall movement of Bitcoin. It's just like the stock market, right? The overall stock market is going to affect individual stocks no matter what, and that's kind of the case right now with this. So hope that helps. Thank you for this. It's been a while since I looked into cryptos, and it's like I said, I'm very comfortable trading, whether it's a stock, whether it's your futures, forex, cryptos. To me, they all print charts, and as long as you have a chart, you can go ahead and trade it from a technical perspective. And I still do like cryptocurrency in the future, but at the moment, like I said, I think that they're struggling, and until we see a change in Bitcoin, I expect the rest of these to struggle too. All right, so that covers it for today. If I missed a question, or if someone has a question that they didn't want to ask in public, you can always message me on Twitter. You can find us on our Discord chat and ask me there. You can email me, stockdarts@gmail.com. I'd be more than happy to help you out there, and give you whatever answer whatever question you have. Other than that, I hope you guys have a good rest of this week, and we will meet again next Wednesday.